Fitch's Fixed Interest podcast delivers the analyst insights and updates you need to stay ahead in a rapidly evolving market. From global macroeconomic trends to sovereign credit developments to regulatory and political changes.
Hello and welcome to the latest in Fitch Ratings Fixed Interest podcast series, this one on the fiscal challenges facing Western European sovereigns. My name's James Longsdon, I'm the head of the Sovereign and Supranational Ratings team at Fitch, and I'm delighted to be joined today by the head of Western European Sovereign Ratings, Federico Barriga Salazar. Federico, at the World Bank IMF meetings earlier this month, tariffs took a backseat, but bubble risks in equity markets and fiscal concerns were very much on everyone's lips. Why don't we first start talking about sovereign rating actions in Western Europe this year and how this fits into the story actually of fiscal divergence and rating convergence in that region?
Thanks, James. Indeed, this year we had seen an increased number of rating actions in Western European sovereigns, both in terms of upgrades and downgrades. We have downgraded 4 countries by 1 notch respectively since the start of the year, including Austria and Finland to AA and Belgium and France to A+, all now with a stable outlook. On the flip side, we have upgraded Portugal and Spain by 1 notch to A and Italy by 1 notch to BBB+, also all with a stable outlook. At the moment, we still have 3 countries on positive outlook, Greece, Iceland and San Marino, while none we have on negative. These rating actions follow a trend of divergence that has been building up over the last couple of years in terms of growth and, more important, fiscal outturns. Broadly speaking, the countries that experienced significant macro and fiscal adjustments following the global financial crisis and the Eurozone crisis are now much more resilient, with reduced macroeconomic imbalances, improved external competitiveness, and better fiscal positions. Importantly, in some of these countries, take Portugal or Greece for example, the pandemic and war in Ukraine did not fundamentally alter their commitment to continue delivering large primary surpluses and a steady reduction in public debt. The result is that credit metrics for these countries have improved, albeit the ratings still remain well below those prior to 2008. For those countries where we have seen negative rating actions, the common thread has been a gradual but persistent deterioration in public finances, in a feedback loop with weak or non-existent growth. Some of this has been caused by exogenous factors, but also by challenges in implementing fiscal measures to offset higher fiscal pressures and higher debt. And the result is that these opposing rating action trends has led to gradual convergence of European ratings, to some extent diluting the concepts of what was once called the periphery and core or semi-core Europe. Beyond the countries that are firmly in the AAA category, there is of course still rating heterogeneity and divergence, and given where the balance of outlooks is at the moment, we would expect to see further convergence going forward.
So if the rating actions have mostly reflected divergence in fiscal outturns and outlooks, can we perhaps talk a little bit more about how Fitch sees fiscal policy in Europe going forward?
Sure. When we look at the median public finance forecast for the region, we expect a modest widening of the deficit from 1.3% of GDP in 24-25 to 1.8% in 26-27. But the range is quite wide. In the next 2 years, we see only few countries in the region continuing to deliver fiscal outperformance and strong debt deleveraging, namely Cyprus, Greece, and Portugal, with fiscal surpluses in the range of 0.1 to 2.5% of GDP, growth in the 2 to 3% range, and debt falling by 4 to 8 percentage points a year. The countries where we forecast fiscal positions to weaken the most are those that have the fiscal space to increase defense spending or other outlays. The prime example is Germany, which has embarked on a multi-annual and large-scale infrastructure and defense spending spree. This, we think, will lead to an increase in their fiscal deficit to over 4% of GDP in the next 2 years, which are levels not seen since the mid-1990s. Other countries such as Denmark and Sweden have also put in place large fiscal packages to tackle defense and other demands, but coming from a position of relatively large fiscal buffers. Finally, there is still quite a bit of divergence in our forecast and fiscal analysis of those countries that have weaker starting positions in terms of high debt and/or deficits. On the one hand, we have countries like Italy, where strong political commitment and growing track record of fiscal prudence will lead to a gradual decline in deficits, thus reducing the risk attached to very high debt levels. In Spain, although there is limited visibility around fiscal policy, strong growth and contained expenditure policies will support modest debt reduction. By contrast, we have other countries such as France and Belgium, where we see persistent policy uncertainty underlined by political fragmentation, which makes it very hard to forecast significant fiscal improvements.
Okay, so given this high profile and importance to the euro sovereign debt markets of France in particular, let's pick up on that a little bit more. Can you talk a little bit about the common fiscal challenges of countries such as France and Belgium, also within the context of recent downgrades of higher rated sovereigns?
So the negative rating actions that we've undertook this year on Austria, Belgium, Finland, and France have had a common denominator: an observed fiscal deterioration, particularly since 2020, and the persistent challenges in correcting fiscal imbalances. One important aspect is that in all four countries, structural fiscal pressures have persisted in recent years, while in many others, the sharp increase in deficits and debts during the pandemic proved more temporary. Fiscal deficits and debt levels are now higher in all four countries relative to 2019. In Finland, debt to GDP is 17 percentage points higher, in France 15 percentage points, and in Austria 10 percentage points. Belgium has experienced a less pronounced increase in its debt ratio, but its fiscal position has undergone a structural shift, with deficits now closer to 5% of GDP compared to an average of just 1.8% in 2015-2019. An additional shared feature of these countries are their very high expenditure to GDP ratios, averaging around 56% of GDP in 2024. These figures are amongst the highest in the world, well above the Western European median of 46.5%. It's only 2 percentage points below the expenditure to GDP high seen in 2020, and on average 4 percentage points above pre-pandemic levels. Although historically high expenditure ratios have been largely offset by high revenue to GDP ratios, expenditure and revenue growth trends have increasingly diverged in recent years, leading to a large gap between them. This has left policymakers in a very challenging position, in particularly as already high taxation levels and weak growth leaves limited room to boost revenue. On the expenditure side, both Austria and Finland have announced and are implementing fiscal packages to limit spending and reduce rigidities, although given still very weak growth, consolidation challenges persist. In Belgium and France, there are similar proposals in place. However, the implementation challenges are much more acute, as evidenced by the recent difficulties in agreeing on 2026 budget measures. And that's not to say about the actual reaching political consensus on multi-year consolidation strategies.
Okay, thank you. But can we perhaps conclude then, let's speak a little bit more about the broader challenges, but also perhaps some of the brighter spots for the region as a whole?
Challenging policy trade-offs are not limited to countries such as France, of course, as we see the whole region facing increasing spending pressures. A few years back, we used to talk about higher defense, aging, climate, and interest costs as medium-term risks. I think it's fair to say that they have materialized sooner than we expected. The biggest change over the last year has been in terms of defense spending in the context of the higher NATO defense spending targets, which are 5% of GDP total spend and 3.5% core by 2035. Versus a current EU median of 2.5%. As mentioned earlier, the countries that have the largest fiscal space is where we see higher spending materializing, but all countries, even those that are not in NATO, are under pressure to spend more. For those countries such as France and the UK, where military strength is a key policy priority but fiscal space is limited, the policy trade-offs are particularly important. Common defense spending is perhaps a way to boost military expenditure, but at the moment we maintain our baseline forecast that only few countries will reach mandated new NATO targets by the end of the decade. Aging cost is tied to demographic trends, which are difficult to alter and to reform. The recent track record in Europe is very mixed, again with countries in Southern Europe making progress since 2010s in terms of increasing the sustainability of pension systems and improving the labor market, mainly through participation, that help limit these costs. Meanwhile, you have countries such as France, but also Germany to some extent, where the inability to push through or implement reforms means that aging will increasingly become a more important factor, adding to further expenditure rigidity and costs. Finally, we are already starting to see the effects of higher financing conditions in debt trajectories and funding plans. This is a slow-moving train, as long average maturities mean that for countries in Western Europe, the impact of higher yields in recent years will materialize only gradually. But these costs are locked in, with a median interest-to-revenue ratio for Western Europe expected to increase from 3.6% in 2024 to 4.8% in 2027. Only in 4 countries in the region we expect no change, while France is projected to see the highest increase at over 1 percentage points by 2027. So to end on a more positive note, the institutional framework in the EU is now much more developed compared to the 2010s, which help mitigate to some extent the tail risks around a more severe fiscal crisis, particularly in the Eurozone. We still see broad commitment across the region, including in the UK, to fiscal rules, even if compliance is patchy. And the example of countries such as Greece show that policy shifts are possible within domestic political constraints, even if the prospects appear far in some countries at the moment.
Well, thank you, Federico, for your insights, and thank you all for listening to the latest in our series of fixed interest podcasts.
Subscribe to Fixed Interests wherever you get your podcasts.